Hey, talking up the UK economy, we have had a bit of a rollercoaster week with the mortgage market, but I wanted to talk macro, I wanted to go global and maybe give you a bit of context around really what's happening and the driver. Obviously, we've had the mini budget, that's had a knee-jerk reaction to the general market. We've got two things, we've got the pound and we've got government bonds. They are the share price indicators for the UK, if you could think of us like that. The pound is our equities, and gilt, obviously, our bonds, what people are buying. Talking through public finances, the mini budget has meant there's been a huge cut, the largest in I think 50 years. We're talking about tax cuts. So the idea is we reduce taxes, we encourage productivity, and the UK people go out and make the most of it, make opportunity. Take advantage of the opportunity rather, and make hay whilst the sun's shining. The challenge that we've got is we're coming off the back of an environment of working from home. We've got people that don't want to go into the offices. We've got a push for a 4-day working week. We've got, all these factors that, in my opinion, I don't think the UK public are up to making the most of the opportunity that's in front of them. The policy's a bit carte blanche. There's not a lot of thought that's gone into it. I don't think. It's just we'll cut things. From the UK property market, I don't think property investors, a little bit biased, are being looked after for the amounts that they invest in, for the good that they do for the housing sector. Separate conversation, we're not going to get into that. I want to talk macro, I want to talk about the wider economy, and really make a few comparisons between the UK and the US. So the UK pound is way down. We're down to about $1.05. We are around 120, 130. Essentially, the UK is on sale to foreign investors. There's a couple of reasons that aren't just public finance related. The UK's Bank of England have not kept pace with the US in terms of rate rises. The US have been very clear. We are going to do whatever it takes to break the back of inflation. That means interest rates are shooting up. Their inflationary environment is very different to our inflationary environment. Their inflationary environment is due to individuals having high demand for goods and services. Our inflationary environment is predominantly driven by energy, number one, out ahead by quite a margin, and then food. So not quite the same. Okay, globally materials are up, yes, but ours is much more predominantly, at the moment, inflation of energy and food. Energy, number one, food, very much a laggard second. Over in the US, it's very demand and services driven. So people are wanting to spend money because they're not getting a return on their funds. What they're doing there is they are pushing rates up materially. Mortgage rates over there are above 6% at present. Until Tuesday this week, you can still get an 80% mortgage at 3.99%. So obviously there's a 2.5% chasm there. If you had £100 to put anywhere in the UK, would you put it in US dollars earning 6.5%, or would you put it into US mortgages earning 6.5%, or UK mortgages earning 4%? It's a no-brainer, okay? That is part of the reason why the UK is on a downward trend against the dollar, as is so many other currencies. This is not a storm that's confined to the UK because of kamikaze Kwarteng's budget. It is global. Japan are doing the same to prop up the yen. China are doing it with the renminbi now as well. It's a global crisis. So, political jostling aside, the UK are not in a great place. The globe is not in a great place. Circling back to mortgages, really had a huge impact with the mortgage market. Lots of products were pulled this week. Institutional lenders are tied to gilts. Now, government bonds are issued at par. So we would issue a £100 bond. You would pay me £100. I would pay you £1 a year. There is a secondary market for those notes, the receivables, the interest that you're going to receive, £1 each year. You've issued £100 to me. Sorry, you've paid £100 for my issue. That £100 is paid back to you in 30 years' time. So this is a 30-year gilt we're discussing. Every year, that bond would receive £1. So if you own it for a year, you earn £1. Someone might offer to buy it from you. If the UK's outlook is amazing, you might be prepared to sell it for £200. in which case that person goes from earning 1%, £1 on £100, purchasing for £200, they're earning £1 on a £200 purchase. The return just cut in half, they're earning 0.5%. Equally, if you think the UK is in a terrible state, you would be prepared to buy my bond for maybe £50. £50, paying £1, the interest return is then is 2%. What's happened is the UK gilts have really risen in price. They were trading above 5% on the 30-year, I think. That is above Greece and Italy. They are cash in hand nations. Tax is very much a voluntary service in those countries. Personally, I think it's knee-jerk, it's market irrationality. I wouldn't get caught up in the headlines. I think long-term, the view is positive, but there's things to work out here. Internationally, everyone thinks that the UK is on sale. If you're in the UK trying to buy and you're competing against international buyers, they've got a 20% advantage if they're purchasing from dollars on what they had 6 months ago. So there's a lot going on in the macro. Coming down to the micro, what do these interest rates hikes mean for property in the short term? Look, the market's already turning from a seller's market to a buyer's market. I think anyone that's in the middle of buying and selling a project at the moment is going to be quite twitchy. If you're selling a property at the moment, you're going to be pushing for it to complete as soon as possible. So there are lots of chippings going on towards purchase prices that are approaching completion. Talking through the public finances, coming back to the budget, just to make sense of this for people that maybe aren't aware. If the UK's public services cost £100, we can fund that by two ways: tax receipts or borrowing. So if we have £100 of outlays per year, we need £100 to meet those obligations. That can be met by tax receipts or borrowing. The government have slashed taxes in a huge way. So the balance needs to be made up by increased productivity, everyone rising to the occasion, working 6 days a week instead of 3.5, and producing more money for that time, not just sitting clock watching, or borrowing. So if we have £100 of obligations and we have £100 of tax receipts, we don't need to borrow. We do not need to increase the deficit. If we cut taxes, which we've done, and our £100 of tax receipts drops to £80 of tax receipts, we have a £20 gap to provide the services to the country that we need to provide. The government can make that up by borrowing. Borrowing, they need to issue debt. So the problem is that the UK right now is not the most attractive proposition globally. Maybe it is, maybe it's not. I suppose that's perception. There's value if you're investing from a dollar point of view. From the pound point of view, we're going down. So that £20 that we need to make up each year needs to be issued. To attract investors to buy that, we could issue it at 1%, we could issue it at 5%, we could issue it at 10%. The market will really decide at what rate that comes out. But obviously it's not great for the country if we need to issue short-term debt at a very high interest rate to meet our monthly to meet our public sector's obligations. That aside, look, that will all play out. That's the macroeconomy. The microeconomy is that there's lots of opportunity in the property market at the moment. And if you are looking for projects at present, the tide has really turned from a seller's market to a buyer's market. So revisit recent offers, revisit properties that are sold subject to contract, because people will be chipping, and it could mean that there's great opportunities to be buying at present. Hope that's been informative, and stay tuned for another video, probably in next week with next week's crisis. Thanks for tuning in.